Hello everyone, Clifford Bennett, Chief Economist at ACY Securities, and markets are working very well for us while they're not working that well for a whole lot of other people. Clearly, equities in the US, big fall, 4 to 5% across the indices, some more than 5% on the day. Remember, I've been saying that recent rally was an opportunity to sell and that the movement up into the inflation data and possibly again a little bit up into the retail sales data coming out on Thursday would be again an opportunity to sell. I thought it could keep pushing higher, but I did say sell aggressively on any turnaround in the price action. So, doing reasonably well in this market. This is the kind of market we thrive in because the biggest opportunities in markets come when what happens is what very few expect. And there's been so many people wanting to just keep buy the dip. You hear it all the time. You get accused of being negative fear-mongering if you're bearish. No, I'm positive warning investors of what will happen. I'm not making it happen. I'm warning you of what will happen. And we've done a very good job of that since the first week of January, saying sell, protect your investment portfolio and sell. And, you have the financial instruments at your fingertips to be doing very well in this market. That was a wonderful move if you do not have a monodirectional approach to things. So it was looking very good indeed. And for those of us who are prepared to go short, but please, I've been asking people all year, we've been giving you the best advice in the world, not advice, the best view in the world all year, which is that markets can go down. I recently said markets could fall another 20 or even 30% from where they were, and we're doing a 5% down in one day. This is how dangerous just being invested and long equities and just hoping for the best. That is not a winning strategy at the moment. The economic outlook is going to get worse, not better. There's no quick turnaround where inflation disappears, the economy rebounds, the Fed stops hiking rates, even cutting rates, and it's happy days for stocks. That is a fantasy. What is happening around the world is that the economic slowdown is becoming more and more entrenched. That means people are going to be squeezed by a slowing economy, high basic necessity prices, and higher interest rates. Europe, United States, classic worst case examples of what's going on. Australia, a close runner there behind. These economies are going to slow further. The end of the slowdown in these economies is not yet in sight. It is far too early to be thinking about looking across the valley and just buying for the sake of it because markets always go up. They do not. Some people who bought in 1929 had to wait 25 years for some of those stocks to get back to where they were when they bought them. Markets don't always go up. Sometimes they go down. Usually when they go down savagely and sharp for a short period of time, or they struggle to the downside for a long period of time. And that's the kind of price action we've been seeing since the first week in January. In the first week in January, the US stock market made new all-time historic highs. And I said at the time, in real time, they could be the highs for this year. And that has certainly been the case. I said it could be a 6 to 18 month correction. There was a risk it would be a 3 to 6 year correction. It's looking more and more like a 3 to 6 year correction. How long do you want to wait? Some of those superannuation funds out there are going to be waiting a long time before stocks get back to the levels at which they've just recently bought them. So maybe the market can bottom. Maybe the market can turn up. It just doesn't look that way at the moment. And my suggestion remains play defense or play multi-direction active, which means you're able to buy or sell according to which way you think any particular market is going. Don't get locked into this idea of you just buy anyway and things will always go up. It's not necessarily true. It might be true over a 25 to 50 year time horizon, but just because that's been what's happening recently probably means it's unlikely to happen in the future, near future. That's how markets work. All right, I hope this helps you. My view is you keep selling Aussie, you keep selling Euro. Remember, I said recently sterling could be going to parity. I've said since the end of last year in my forecast for the year ahead that the Euro would go to 97. I updated that recently to 88 cents. I think I said before the war started in December last year, the Australian dollar could go to 65 cents this year, risk 58 next year. I still feel that way. There's still a lot of downside in currencies. It's basically at the moment, globally investors are deleveraging, getting out of almost everything. And the only thing they feel safe about, and I'm not sure it's a good idea, but it is what the herd is doing, rushing into the US dollar. And that's going to continue. I also recently put out a special report saying, is it time to buy the yen? And that was very timely indeed, because it has indeed been time to buy the yen. So keep an eye on that market as well. We're always here to help. Clifford Bennett, Chief Economist, ACY Securities. Thank you very much.